Hi everyone, today we're going to be talking about the purposes of valuation. There are more than one purpose of valuation, and with each purpose of valuation you can have a different basis of valuation. Now if you have a different basis of valuation, you need to clearly state in your valuation report what that basis of valuation actually is. If we refer to the Old Testament, Doc Murray's book, it says, one value for all purposes. The purpose for which the valuation is being made in itself cannot and should not affect the value ascertained unless the method of valuation and the basis upon which it must rest are prescribed by statute. The value to be found normally is the market value, and there cannot be two values of the same property at the same time. The valuation for mortgage purposes should be identical with that made for any other purpose, and the task of the valuer is to determine the correct value. It is only in cases in which some value other than the market value has to be ascertained that a property can have two or more values at the same time. The RICS Valuation Professional Standards for 2014 indicates for VPS 4, Basis of Value, Assumptions and Special Assumptions, that the valuer must determine the basis of value together with any assumptions or special assumptions that are appropriate for every valuation reported. Therefore, the basis of value can be recognised bases of value, market rent, investment value and fair value according to the RICS guidance. You can also have regard to assumptions, special assumptions, valuations reflecting an actual or anticipated market constraint or forced sales, and special assumptions related to projected values. It then goes on to say, recognised bases of value. In accordance with the IVSC definition, IVSC being the International Valuation Standard Committee, a basis of value is a statement of the fundamental measurement assumptions of a valuation, and for many common valuation purposes these standards stipulated the basis or bases of value that is appropriate. It continues. For most valuation reports, it will be appropriate to use one of the bases defined in these standards. RICS does not encourage the use of a basis that is not recognised by these standards. However, if no recognised basis of value is suitable for a particular assignment, the valuer must clearly define the basis adopted and explain in the report why use of the base recognised by these standards is considered inappropriate. The European Valuation Standards goes even further and says, for EVS2, the valuer should establish the purpose for which the valuation is required before using any basis of value other than market value. Only recognised basis of valuation and reporting practice that are comparable with international practice, European, remembering this is European focused, and national laws, regulations and client needs should be adopted, subject to the overriding principles of transparency, consistency and coherence. Such other bases of value may need to be used as required by law, circumstances or a client's instructions where the assumptions underpinning market value are not qualified or cannot be met. The result will not be market value. If you're doing a valuation for any basis other than market value, then you will need to clearly stipulate what the basis of that valuation is. If you refer to the Australian Property Institute Business Focus 14.3 on reports, content and compilation, you will see that there are three main types of valuation report. They are at 3.1, self-contained or comprehensive style reports, which are long reports, summary or short form reports, and restricted or pro forma reports. you will need, as being the valuer, to select which report you think is most appropriate for the basis of valuation that you are going to embark on. The purposes of valuation are many and varied. There is just not one purpose of a valuation. The first type could be mortgage security, for example. That is the most appropriate type and the most popular purpose of valuation that valuers in Australia anyway tend to get involved with. And of course you've got first mortgage valuations, second mortgage valuations and third mortgage and so on. First mortgage valuations are often undertaken on a pro forma, or even if they're residential properties, a property pro valuation report format. If you become involved with second or third mortgage valuations, then it becomes a little bit more complex. These valuations need to be treated with a little bit more care because they are higher risk valuations, and therefore greater explanation of assumptions, etc. need to be included in your valuation report, and these valuation reports will by definition be undertaken on full or comprehensive valuation reporting bases. Other purposes of valuation can be market value for portfolio or superannuation purposes. A superannuation portfolio may need to be regularly updated in terms of the value of the property, and this will require you as a valuer to go out and do a regular update on the valuation. Valuations can also be undertaken for stamp duty purposes. Now, stamp duty purposes are also often undertaken on, or should be undertaken on, a market value basis. Capital gains tax, you can do a valuation for capital gains tax purposes, and again you will be coming up with a market value assessment. Same applies for the GST margin scheme. Now, the GST margin scheme particularly applies to properties owned or purchased prior to the introduction of the GST on the 1st of July 2000. However, there are other reasons why GST margin valuation would be required. Your client would be well advised to have a chat with their accountant before embarking on a valuation report. Valuations can be undertaken for pre-purchase. So people wanting to buy a property may require the comfort of a pre-purchase valuation to ensure that the amount that they are paying is not unreasonable. Probate valuations for deceased estates are quite common. They are done on market value bases, and as with all valuations, need to be undertaken on quite an accurate basis, because a lot of the breakup of the estate will be based upon the probate analysis that you arrive at. Valuations can also be undertaken for land value purposes. Now, land value purposes are a statutory valuation. When I speak about land value, I'm referring to land value under the Valuation of Land Act for rating and taxing purposes. These valuations are not undertaken on market value of the whole property. They are undertaken according to a different value definition, and that is contained in the Valuation of Land Act 1919 here in New South Wales. Your valuations need to strictly adhere to that definition, including allowance for improvements to the property and improvements to the property. Insurance valuations are also undertaken exclusive of market value. There are two types of insurance values. There is the typical reinstatement and replacement insurance assessment, which is based upon the construction cost of the building plus other add-on costs, which will be discussed in another video. The second type of insurance can be the indemnity insurance. Indemnity insurance is slightly different to reinstatement and replacement, and is done on a different basis. So you need to ensure that you are valuing according to the correct basis. Usually that will be reinstatement and replacement of old with new. Due diligence. Sometimes companies require due diligence valuations in order to update their balance sheets, or in the event of a company being purchased or taken over. You can undertake a market rental valuation or a market rental determination valuation, and these involve not using the standard definition of market value for land, but using the standard definition of market value for rent. You can have a look at feasibility analysis or on completion valuations or hypothetical developments, particularly for development sites. Be a little careful with those. They are a point of contention at the moment. Valuations can also be done for costing and progress payment purposes. Often a costing will be undertaken on a new proposed development so that the progress payment schedule can be formulated for the valuer when they go out and update according to the stage of construction at that point. Then we get into the various litigation valuations. Litigation valuations can be family law court, compulsory acquisition, all sorts of litigation purposes. You need to be careful about some of those valuations because some of them may be backdated to a particular date, such as issuance of a PAN notice or date of gazettal, a whole stack of reasons. So just be a bit careful about those. The standard of proof is quite high, and if you do end up presenting your valuation in court, you will be needing to justify the basis of your valuation and your valuation methodology in great detail. Okay, well, I hope you've got something out of today. Thank you for watching.